Good
While I am
afternoon.
So
Good
I am
getting my
afternoon, and
finding
screen in
welcome
my
to
place.
Justine Peterson Presents Illinois Ignite program. Today, our presenter is Nate Salah. Nate, I'll turn it over to you.
Thank you so much. I appreciate it. I appreciate you. We are going to do round two of our advanced tax strategies. From the first round, we talked a lot about different strategies. We're going to go deeper this round, and it's like drinking from a fire hose often when you're talking about tax strategies. And so it takes some time to digest, even from accountants. A lot of accountants don't. Well, they need time to really understand some of these strategies and how the strategies work. So we're going to go through and really just analyze and dive a little deeper. And then today is going to be a really good way to plan also for the new year because it's the end of the year and people have questions around what should I be doing, what should I be buying, should I be prepaying expenses, et cetera, et cetera, and I should be planning for the end of the year. So we'll look at that as well. And for those who are watching, you see I am wearing my Santa's helper hat. So when I do have client meetings this time of year, we do tax planning meetings end of the year. I just explained that I'm one of Santa's helpers helping our clients get adult gifts called money. And I haven't had a person yet who said, I don't want that gift. So it's important because the money is yours. The money is yours. You just don't always know how to access it from the government. So we're gonna work through that today. So I've just pulled up my presentation, and we'll go line by line. We'll go strategy by strategy. And if you have any questions throughout, just drop it in the chat, and be happy to answer any of those that I can. Remember that all tax planning and tax strategies are based on your individual situation, which means that these strategies may or may not apply to you directly. It may be something that might apply in the future. And so it's always important to consult a tax professional. So these are tools in the toolbox. And so you just have to know how to use those tools. And sometimes some of these tools you can use on your own. Some of these tools will require someone who has expertise in that application of the strategy. So always remember that when you're strategically planning. All right, so this is part two on top 10 tax strategies to maximize your small business profitability. We're going to start with the very first one, which we discussed a little bit. Let me go ahead and do that. Entity elections. And so last round, we did talk a little bit about the S Corp election, and some questions arise like, hey, should I stay an LLC? Should I stay a sole proprietorship? Should I stay a partnership? What should I do? And so I do want to talk a little bit about that just to kick it off. So if you're currently a sole proprietorship and you've gotten the email or the friend nudge or the accountant or somebody who said, hey, you need to be an S corp. It's not always the case. Not everybody, it needs to be an S corp. In fact, many small businesses don't need S corp election status. And so I'm going to talk a little bit about what those businesses are and how that's structured so that you know when to consider pulling the trigger on the S corp election. Before I do that, I'm going to explain again, just to refresh everyone, the benefits people normally tout, if you will, for the S corp election. So you have different ways to be taxed, essentially, and I just named a number of them. And so whether or not you form an LLC, whether or not you form a sole proprietorship, those are usually triggers, if you will, to how you're taxed initially. And then you have to make a decision. Okay, do I want to be taxed as an S corp? The reason people generally are taxed as an S corp for tax savings, there's a lot of nuances to it, which is a seminar in and of itself. We can spend a whole day talking about S corp. But the reason is because they won't have to pay self-employment tax, 15.3% on any of the net profit outside of their own wage. So what does that mean? That means like if you're an LLC single member, if you're a partnership and you're active partner, or if you're just a sole proprietor and you just have a DBA or a assumed name or a fictitious name, any way we describe that, you're going to pay on 100% of that net profit, you're going to pay 15.3% self-employment tax up to the first approximately $170,000 and it keeps going up every year how much you pay, and then it's capped. The Social Security is capped. Medicare continues on, and so Social Security is at 12.6%. And so what does that mean? That means that means you have a lot of taxes you're paying in self-employment. Say you made $100,000 in your company, and you pay $15,000 in self-employment tax. Well, you say, I don't want to pay that kind of self-employment tax. I just want to be an S corp. All right. So we form an S corp election, and then a lot of accountants say this, oh, just be an S corp. And then you do your taxes again next year, and you have to pay self-employment tax still on your wage. Now, say for example, you are the only member of the company. No one else is generating income. No one else is generating net profit. Whether or not you're an S corp at that position makes no difference for tax purposes because you have to take a reasonable wage. You see this third slide, it's part of the slide here, pay yourself a reasonable salary for your labor. Well, if you labor for 100% of the profit, net profit, then you're required to take a reasonable salary to that 100%, aside from, of course, not taking distributions. So you can't take a distribution in lieu of salary. So you can't say, oh, I wanted to take $50,000 in salary and $50,000 in distribution. If you're 100%, you can't do that. So, like for example, sometimes an example might be a real estate agent. You're independent and you don't have anyone working for you. You generate 100% of that profit. You're responsible for 100% of that Social Security and Medicare on that income, on that revenue, net profit revenue. So in that case, the S corp election makes no sense at that time. Now, if you have others who are laboring to produce net profit, then that's when the S corp might make sense. However, if you have others laboring to produce net profit, but you're like, Nate, I'm not making any money. I'm still like at negative, right? Or I'm still just barely making ends meet. I'm not even taking a salary because we're still building the business. Well, again, there's no reason to form the S corp election because at that time you don't have any profit to pay self-employment tax on. So why go through all the trouble and all the cost and to form an S corp? And then of course the tax preparation is more expensive than the Schedule C generally. So you're not in a better shape for that. So that this is very important because you may currently be in an S corp and you might need to revisit it, have your accountant just revisit it annually. Is it the right formation for me? You may not and be considering it. Have a conversation with an accounting professional to run an analysis for you to see whether or not the timing's right. It may be a year down the line. It may be 2 years down the line. And then you may not even want to be an S corp. You might want to piggyback over that because there's other opportunities. Say, for example, you might want to sell your business in the future. Well, if you want to sell your business in the future, we might want to actually form a C corporation and then have small business qualified stock or SBQS election because you can take up to $10 million at that point of capital gains. In other words, you can say, for example, you keep the business for 5 years and then 5 years later you sell it for $10 million. You may have to pay $10 million in capital gains on that. Well, 20% max capital gain rate plus the Medicare tax, 3.3 over 3.8% there. So there's 23.8%. So that's $2,380,000 that you'll pay in tax. Now, if we do this election and we do it properly, then we qualify under a section called 1202B. 1202B allows us to have all of that capital gain up to the $10 million tax-free. So what does that mean? That means that $2.3 million in tax goes away, all of it. Pretty cool. So you say, Nate, I'm not selling my business for $10 million. Okay. But if you do plan to sell your business, we need to have a conversation. You need to have a conversation with someone. And as a professional who understands these tax laws, especially these advanced ones, and say, hey, I heard in a webinar something about a qualified small business stock or a 1202B. Help me to understand because I don't want to pay any more tax than I have to. It's a very powerful tool if you are going to sell and you're going to make money from the sale. There's a lot of things that have to happen, especially with the C Corp election. You say, well, aren't I taxed with double taxation with a C Corp? Yes, you are subject to double taxation. You're taxed on the net profit. C Corp has a 21% flat fee on their tax. However, you're also taxed on money coming back to you. They're not called distributions in a C Corp. They're called dividends. And you've probably heard of dividends. Well, there's ways around that too, that allow for some of that net profit to come back to you, possibly royalty agreements, intellectual property agreements, et cetera, that bypass that double taxation. So this is advanced tax strategy. So what I'm saying, 99% of accountants don't even know this stuff because they just don't deal with it every day. So you do have to find that 1% who do understand this, accountants and attorneys who know how to set these complex tax strategies up. But I just want to get it on your radar if you ever do plan on forming an S election, getting your business sold, exit strategies, succession planning, all of that has a lot of bearing in this area. So get on the radar so you understand that there's tools and ways for you to reduce and oftentimes eliminate taxes altogether. It's Jedi stuff. All right, next. If you do have an S corp election, or if you do have a any type of corp election, you will now have you can't deduct your home office anymore. So if you were a Schedule C, if you had a partnership, you could still take deductions for that on the individual tax return. It's gone if you're an S corp. So you have to set up what's called an accountable plan. So for those of you who are like, yes, I have an S corp, or yes, I'm going to have an S corp, this is important. An accountable plan is a reimbursement plan that reimburses for your expenses that are out of pocket used for the business. And oftentimes we relate it to a home office expense or other types too. But we just like to talk about home office. So if you actually have a physical home office, a lot of us do. I have one in my basement, and that's where I do my work, whether it's on the weekend or whether it's in the evening or whether sometimes in the off season, I'll work out of the house 1 or 2 days a week. And so I want to get a reimbursement for the percentage of business use. So that office has a percentage of the entire house. So if it's 10% of my entire square footage of my home, then I want to get a reimbursement for 10% of those expenses: office, my internet, my phone, any type of expense, utilities, maintenance, improvements, that cleaning bill, all of those pieces, you get a 10%. Now, if you're doing deductions which are related directly to that office only, not to the whole house. Say, for example, you built out your office or you bought some furniture. We'll talk a little bit more about furniture later too. That's 100% deductible. So what does that mean? So say I painted my home office and not the whole house. Well, that is directly related to that office space, and that's 100% deductible as well. So very powerful tool. You probably, a lot of people have done that with their Schedule Cs, but when they go to the S Corp, they forget about it. And the accountant usually says, oh, you can no longer deduct your home office expense. Yes, you can. You have to do it on what's called an accountable plan. So if your accountant's telling you no, say, hey, I was at a webinar and I need to talk with you about this because I was told that there's a possibility for me to deduct these through the accountable plan. And I don't want to lose money that belongs to me. All right. That's the accountable plan. Of course, you want to keep a written plan and document those reimbursements as well. Now, I did briefly talk a little bit about the Augusta strategy last round. I'm going to go a little deeper this time. So what's the Augusta strategy? Well, it's Section 280A-G, if you will, of the IRS code. And essentially it says that you can rent your home for up to 14 days to anyone, really. It doesn't have to be your business, tax-free. Okay, so the IRS is not going to require you to pay taxes on, by the way, any value, fair market value, for your home. So say say you Airbnb'd your home for 14 days or less. Guess what? No tax, no reporting. It's pretty nice. So what does this have to do with my business? Well, say, for example, you had a training at your house. Maybe you invited some folks over for a company event. Maybe you had some clients come to the house, some customers come to the house. I used to have back in the day, before we got before we were year round, we had a year-round office, we were in the malls, and we were only in the malls during tax season. Outside of tax season, I just had everything at my residence. And so I would have clients come to the house. And then when they came to the house, well, guess what? I would be using that space to conduct a meeting with my client. I could have been using that for rental, and I could have charged the business fair market value. So, say for example, it's 500 bucks a day or 500 bucks for half the day if I was going to rent space out. Well, I'm just going to charge the business that $500. Business is going to pay me directly. Business is going to take a deduction for the expense. And then guess what's going to happen next? Well, what's going to happen next is I'm going to get that money in my pocket tax free, which is nice. So we have to do several things in this rule here, and this is where we go a little deeper. Number one, we have to document that fair market rate. So what I would we do here is we'll look for comps. We do comps of meeting spaces in the area. Step one, find two comparable meeting spaces in the area. And then when you do find those, then take a screenshot of where they are, document the cost per hour at those, or if it's a half day or a full day rental, whatnot, and then use that as your rate. Now, be very careful, because if use a big ballroom and you say, well, this ballroom is $10,000 a day, and you're only having a meeting with one person, and the IRS asks, well, how is that ordinary, necessary, and reasonable? That's the language they use, ordinary, necessary, and reasonable for your line of work. Did you need that big ballroom? And so you might be able to tell a good story, but I don't know if that story is going to fly, why you would need a big ballroom for a two-person meeting. So you want to be accurate with what is ordinary, what's necessary, and really what's reasonable for the activity that you have. So it's a small space, right? Now, say for example, you are going to have a big event, and you say, I'm going to invite all my clients to my home for a client appreciation day. And so, you have, I don't know, 50 people at your house. Now, that would make an argument for a much larger space. And then once you've documented that and who attended, that is your proof that it's ordinary, necessary, and reasonable for that type of activity. So it's very important to align those pieces. And then from there, you want to be just like a regular company. You want to invoice the the company, your own company. You send them an invoice for that service, rental for X number of square feet for this date. And then you also want to record what we call minutes. Okay, minutes are like meeting minutes. So whatever it is that happened during that time, you want to make sure that you record all those things. So you really need three pieces of information. You need number one, the comps, the comparables. Number two, the invoice. Number three, the minutes, which include who attended, and of course what the purpose of the rental was for that time. And with those three pieces of documentation, you have a very strong case for the allowance of that expense. Okay, it's a pretty cool tax rule. Now you say, well, what if I just get together once a month with my business partner and we go over financials, we go over employees, we go over year-end planning, we go over all of the standard operating procedures. Yep, that qualifies, right? That's a bona fide business meeting. If you were going to go someplace, I say I'm not going to use my house, but I'm going to go rent a space. Okay, you're going to go rent a space for it. That space is going to cost you money. You're going to bill it to the company. So what you're doing is essentially you're doing the same thing, but you're just taking advantage of a tax law that allows you to have zero taxable income from those first 14 days in the year. Okay. Pretty cool. Pretty cool rule. Again, going deep dives on some of these so that we got more information now. Once we got past sort of the initial of like, what is the tax rule? This is a deeper run on how to make that tax rule stick. And here's the other thing. As you begin to think through these things, if you still need help, there's help. You can, whether it's us or someone else, at least you have a better understanding of how to structure these now. We talked a little bit about hiring your family. Again, we breezed right through it. I'm going to go in deeper today. This is actually a big topic, and some people use it, some people don't use it, some people abuse it. So today is the day to really dive deep into it. So paying family members for legitimate work, you say put legitimate work there, right? It has to be legitimate, has to pass the sniff test, ordinary, necessary, reasonable. And so the rationale here is we're going to shift income from your higher tax bracket, likely, to lower or zero tax brackets. So for 2025, we've got $15,750 is the minimum threshold for paying any tax. So in other words, on wages, if you can earn up to almost $16,000 and pay zero tax on your wage. Well, what does that mean? That means that our kids who are maybe just sitting at home doing nothing or playing video games or whatever it is, get them off that couch and put them to work. Okay. Hey, I'm not going to wash the company car today. You are. I'm not going to take this trash out of the home office. You are. I'm going to have you go with me and say back to that realtor example. We got some signs to put into a new property. We're going to go stage a new property. You're going to go with me. Okay, here's a hammer. Okay, you're going to nail this sign in. Okay, you're going to move some of this furniture around. We're going to take these photos. All of those items, then what happens is you then can compensate your child. We want 8 years or above for actual physical labor. We've got some other things for non-physical I'll tell you about. And so you pay them. So say, and we use a log. I would recommend, and I'll go through all these pieces right now, how to document it. Number one, you want to document the child's age, the description of the work. Okay, the description of the work. And then you want to document the log, an hourly log. We provide our clients in our advanced tax strategy program a yearly long log so they can document every single day how many hours, what the tasks were for each particular role of physical labor for our children. Now, the words child labor has a very negative connotation in our country because of underage labor that was excessive. That's not the case here. You're not going to go to jail if you put your kids to work. Now, if you got them in a coal mine 14 hours a day, that's a problem, right? But if you take them on, I used to bring my son in all the time and do things with me, and he'd do some clerical work, things like that, or at the home office too. So I take him on meetings. I would take him to we would had something called a monthly a networking meeting. I would take him to that for business, and I'd have him talk with people, and inevitably we would get new clients. Well, I should be compensating him for that. That's legitimate work, and he earned that money, and so we shift the income, move it over to him, and then what happens? Well, then he gets to spend some of his own money on buying some clothes or buying that next toy, that next thing, instead of me having always purchased that. Teach him a sense of responsibility. Boy, don't we need that today. We need to like stop entitling our children, and I'm super guilty of it. Give them actual incentivized work that they can feel proud of and they can contribute to the family work, the family business. They can contribute to the economy, and they can learn about how to work diligently. So it's a great opportunity for kids, and it's a great opportunity for us as well, because then what we do is we take some of the money that we would be spending in the household anyway. We make that completely tax-free by compensating our kids with it. And then we can allow our kids then to utilize some of that money for their own needs, i.e., they can also save. They can also do some really cool things with it, like, for example, start a retirement account. Once your child, and again, we're going a little deeper this time. We didn't talk about any of this stuff at length in the last round. Once your child has earned income, so say you have a 10-year-old and you had $6,000 this year that they worked for all year long, whether it was the summer during vacation or weekends or whatnot, and they earned $6,000 legitimately through helping you. Well, that's $6,000 that you don't have to pay tax on, right? So say you're in a 30% tax bracket. All right. So on that $6,000, you just saved $2,000 in taxes. That's fantastic. So now that six becomes eight, and now there's $6,000 in their account. Okay. And so you can sometimes, I would say, hey, you know what? Don't spend it on anything. Let's invest it. Let's invest 100% of it. If you put that into a Roth IRA, so you invest $6,000 into a Roth, you do that annually. By the time that child is 65 years old, on average, for approximately a $370,000 total investment, that investment will be worth over, just at a nominal rate between 5 and 6%, over $3 million, between $3 and $4 million. You see, friend, we can teach our kids compound wealth building. And I didn't learn that when I was a kid. I grew up poor. And honestly, I think oftentimes poor parents teach their kids to be poor parents. And so we need to break that chain. We need to break that. And we need to start learning how to have financial literacy and be savvy and teach our kids savviness and don't just give them. So the hire your family piece is a huge opportunity. There's certain documentation rules with it. If you do have that S corporation, we want to create a second company, which is a single member LLC called a family management company. Because if you pay your kids directly through that S corporation, then they're subject to Social Security and Medicare. And if they're not, if they're paid through a sole proprietorship or a single member LLC, or they're not subject to Social Security and Medicare. So you bypass the 15.3% we just talked about in a couple slides ago. And so keep this in mind when you do it. You also have to document, make sure those items are documented in terms of what they did, when they did it, and that it's not excessive, right? So you're not paying your kids $500 an hour to do janitorial work. Now, different kinds of work have a different pay scale. So you can look up, we do this, we look up what the rate is based on proficiency level, based on their age, and apply a reasonable compensation for them. And there's other things. We have our likeness usage agreements. So for example, if you have a business and you're photographing your children, you're putting them in the business, well, you can pay for those photos, exclusive licensing of those photos. And we do the same thing. When my son was young, another story of us, I would put a picture of him myself in our annual flyer. I would put it on the website, or I do social media posts all the time and promote the business with my family members. Well, again, that's worthy of compensation. If you are buying those photos royalty free, there's that. There's photos that you buy licensed copies of, and those cost. So you might as well be paying your family for those photos, your children, and then being able to take the tax deduction for it. Okay. So that's the route. Now you have to make sure that you pay them in the year of the tax law of the tax year to get that deduction. Some deductions you can do it after the 31st, but you got to make sure to do that. So the money has to move. If it's an S corporation, has to move from the S corp. The family management company has to invoice the S corp for the services. We just like to say like management services, and then that money goes into the family management company, LLC, and then from there it moves into the custodial accounts for the kids. We say custodial accounts just means that the parents have access to those accounts. And then from there, the money can go anywhere you want. Honestly, if you told your kids, if you're if you're the legal guardians of your children and there's no legal stipulations, you can tell your kids, hey, we're putting right back in the family pot because you're contributing to this family. You can put it back into the business if you so desire, and say, hey, we're putting it right back into the business because the business could use a loan from us, you see? But it exits as an expense. It comes back as equity. So again, these are complicated strategies. These are advanced strategies. So you must consult with a professional to make sure that you're not breaching the tax law and you're doing it according to the regulations. We always want to make sure we're doing it to the regulations, doing it appropriately, ethically, and legally. because they're good deductions. But if you go sideways left and right, you don't have the right documentation and you miss things, or if you abuse the tax law, well, that could be very problematic. Okay, so that's a little bit more, a little deeper on this hiring your family piece, and you can see if you're listening, if you're watching, you can see the power of this because some people have like 4 or 5 kids. Like I'm putting them all to work. They're all going. And honestly, wasn't that the way it used to be back in the day when families worked together? It was a family experience. And for some reason, we've lost some of that in our society. We need to regain that. So that's a great way to shift income lower or non-existence tax brackets and really save some money. All right. A lot of people are asking about end of the year. What can I deduct? What can I buy? What should I buy? It's December. I got my hat on, my helper hat on, and I got snow behind me in the picture. I got snow outside too. Section 179. This is a very common section. A lot of people have heard about 179 bonus depreciation. And you may have heard the president reinstituted bonus depreciation back to what we call 100%. So it was declining. It was at 100% for a while, and then it kept declining from 80 to 60, 40, and then 20, and then it was going to go away altogether. So this is a big, big benefit for a lot of folks who are buying equipment and vehicles at the end of the year. This is the time. So here's my philosophy. Now, before I get to the vehicles, anything that I'm planning on buying in the first quarter of the next year, I'm going to go ahead and buy now. Buy before the end of the year, put in use before the end of the year, because it has to be purchased and put in use. So don't buy it on 12/31 and get it January 2nd. Doesn't apply. Buy it on 12/22 and make sure you get it in time. Of course, it's the holiday season. Lots of things are on sale right now. What I'll do is I'll do an inventory. I will do an inventory on everything that I will need. So I just bought a printer today. One of our printers went on the fritz. Boom, bought a printer, looking around the office, having a conversation. What is it? I don't want to hear about something January 3rd and saying, oh, I need this piece of equipment. Why? Because this gives me an entire year in advance to collect additional money from the IRS and lower my tax burden. Because if I can find another $10,000 worth of expenses, I don't know what your number is, but whatever it is, well, if I'm in a 20, 30, 40% tax bracket, whatever the tax bracket is, that's going to be dollars in my pocket. So say it is 30%, just a round number, which is kind of an average tax rate. Well, on 10 grand, that's $3,000 in cash. I'm not going to have to give the government. That's $10,000 in cash that I get to use the whole year to cash flow my business. Tax free. So that's really important. And so when I'm thinking about it, I don't like to ever, people say, oh, I need to go buy something. Don't just buy something. Only buy things you need. And even more importantly, buy something you're going to need in the first quarter. Because if you got to buy it anyway in the first quarter, you might as well buy it and have it in use before the end of the year to get that tax deduction and not to have to wait an entire year to get that deduction and use that money. That's very important. And then the other piece of it, what about the cars and the trucks? Well, if you do buy a vehicle and it's over 6,000 pounds, if it's a pickup truck, generally an SUV, you will have a deduction of up to 100% of it, depending on the business use. So if you use 100% of the business, in other words, you don't use it for personal at all, it's possible that you would be able to deduct 100% of it. So say you bought an $80,000 vehicle and it's over 6,000 pounds, it's 100% used in the business, then it's likely that you'll be able to take $80,000 off of your taxable income. And this is actually a really good time of year to do this because you could strategically purchase it the last couple of weeks of the year, which we're getting very close to that, just drive it for business through the end of the year. And then you're able to take that 100% deduction. So say, for example, you had bought it in June. Well, you might have more personal days, and that percentage of personal days that you have actually decreases the percentage of deduction. So if you use a 50% business, you're only going to get 50% of that total vehicle cost. And then at under 50%, you don't get the bonus depreciation anymore. So it's 50% is the minimum. If it's less than 6,000 pounds, you still get a deduction. It's just capped, just over $20,000, which is still great because you might be saying, Nate, I don't want a $80,000 vehicle. I don't want a car note. I don't want to tie up my cash. Okay. But you know what? There's this little, pre-owned vehicle that I'm thinking about getting, and it's $20,000. Great. We can take that full $20,000 as long as it's 100% business use. So that's fantastic. This time of year, I am scanning myself. I'm scanning. Do I need a vehicle? And if so, when's the time to buy it? So that's the vehicle piece. Also, anything that you have in your own repertoire of inventory that you purchase personally that you use for the business, you want to make sure the business owns that. What does that mean? That means that, say, for example, you've got a desk in your office at home, or you transferred something from your home to the office. That plant behind me, I've got plants all in my offices. I got so many plants that a lot of my team members are like, we don't want any more plants. Even Ann across the river was like, hey, I don't want these plants. These plants are ugly. It's like I brought them all from the house because we moved. I had lots of plants in my last house, and we downsized, and I didn't need them anymore. Well, guess what? I never sold those to the business, but the business is using them. So the smart thing to do would be to take the fair market value of each of these plants and then write a bill of sale, sell them to the business. The business takes a deduction. You can 179, all of this kind of stuff. And guess what? I don't have to pay any tax on it because I paid at least that amount, if not more, for any of these amounts. Now, granted, if you sold it to the business for more than what you paid for it, you would have to pay tax on the difference. But most people aren't going to sell something for more. Generally, things don't actually increase in value, especially plants and furnishings and whatnot. But that's important. So you're a great tax hack, if you will, at the end of the year, is to go around and take inventory. Take inventory of everything that you brought to the office that's being used in the office that's personal. And so it could be artwork. I've got artwork in here I brought back from the house. I've got all kinds of things as I look around. I still need to inventory some things. In my home office, there's a lot of things in my home office that are in my home office that I utilize for the business. So then you write the bill of sale, your business takes an expense, you don't claim any income provided it is at least less than or equal to what you paid for it. Fantastic, because I've had clients who they've had 10, 20, $30,000 worth of items that were just not being written off by the business, but they paid for a person. Now, of course, at that point, the business does own them. You can't turn around and sell them back to you for $1. That would be an abuse. Um, but you certainly can continue to utilize them in the business. I know my wife's never going to want that plant back. So there you go. Beautiful tax hack when it comes to that piece. The third piece I want to talk about when it comes to bonus depreciation or end of the year or talking about equipment purchases is prepaying expenses. If there's any expenses that you can prepay toward the end of the year, whether it's subscriptions or dues or whatnot, and again, if you're going to be paying for them again in January anyways, if it's for a service that you have that's going to be going for the entire year, consider, if you have the cash flow for it, prepaying for it. Because if you prepay, you're going to pay it anyway, but then you get the tax deduction now instead of having to wait an entire year. Good stuff. All right. Next, I know I'm throwing a lot at you, and so I'm glad you're bearing with me. This is deep. It's good stuff. Just all tools in your tool belt. Retirement contributions. This is something I wanted to talk about. 2025. Your solo 401k. If you have a small business and you're solo, you can. I'm not sure. It might be a little too late to open this one up, but you can still open a SEP. And a defined benefit plan might take a little longer, but definitely the SEP is no problem to open now with your financial advisor. And that you can fund all the way up until the filing date. So say, for example, you want to do some pre-tax and retirement contributions. You can do that all the way up until April 15th, or with an extension, October 15th. Of the tax year if you qualify for that particular type of benefit. So I just want to get you that on your radar so you know those aren't like super urgent unless it's a solo 401k. Another way to maximize retirement contributions, and a lot of people don't know this, as far as 401ks or IRAs, for those who may be listening or watching who are in the real estate space and buying and selling real estate, you may want to consider looking into a Roth IRA, a Roth 401k. So a solo Roth 401k, and this is a vehicle to where you can buy property inside the Roth, sell the property inside the Roth. And as long as the property appreciates within the Roth, you see Roth IRA, all earnings are tax free if it's held for a minimum of 5 years and there's up to 59 and a half, or over 59 and a half. So you could theoretically make millions of dollars in real estate and buy it buy and sell within the Roth, and hold it to the holding periods that preclude you from having any taxable income, and you can pay zero tax on all of those millions of dollars. It's powerful. It's very powerful. You can take some cash out, but of course that cash that you do take out is going to be taxable. So if you're in the real estate space, talk to your financial advisor, talk to your accountant about a uh, a Roth 401k to possibly put your funds into. Okay, so what happens? You save money, you compound growth, you build wealth, right? Uh, Pay out your future self instead of the IRS. That's the goal with some of these retirement accounts. These are just a few of them, but I'm running low on time, so I won't go into a lot of depth on some of the other ones. Next, education, meals, travel. Now's the time to plan for 2026. Training, conferences, seminars, anything that's out of town. Here's what I like to do. I like to couple my planning of future events with some kind of a business activity. So what does that mean? That means that if I have if I want to go to Florida, okay, what can I do down there that has a workshop or a seminar? Is there an IRS seminar? Is a leadership seminar? Is a business seminar? I went to Las Vegas last 2 weeks ago and had a business growth seminar, scaling seminar. And 2 days of that, I get to deduct the travel there, the travel back, the hotel during the seminar. And guess what? Get to have some fun too. Of course, I don't like going to Vegas. I hate Vegas, but that's just so happens where it was. I ended up going to California and Southern California, hanging out with my son a couple days there. That part was not deductible. However, it got me pretty far to get to the Vegas thing. So you can see how you can maximize that. So think about your trips. Think about where you can have a bona fide business activity there. You can deduct the day before, the day of, and the day after in terms of your meals and your lodging expenses for those events. Of course, you want to document everything. Document who you went with, where you went, why. Was it ordinary, necessary, and reasonable? But it's actually a pretty good hack when it comes to deducting travel and having some fun at the same time. If you're going to utilize some trips and go on some business travel. So start planning for 2026 in that way. Next, charitable contributions. It's end of the year, so you can start emptying the basement or the garage with all of those extra things that have been collecting, all the clothes you never wear anymore. Start bagging it up. I had 3 huge bags, trash bags, some big trash bags of clothes out of my closet. I had to use 2 hands to carry them each out into the car this year. It felt so good. It felt so good to just empty all the clutter, things I just don't wear, and take the tax deduction for it. Now's the time to do that. Okay. Take a photo of all the items, document the items, and take them to your local qualified charitable organization, whether it's a Goodwill, a Savers, whether it's Salvation Army, whoever it may be. You're going to help people out and you're going to help yourself out because you're going to get a tax deduction possibly for that deduction there. Next, donor advised funds. This is really important. Sometimes, at the end of the year, for those of us who do like to give, we don't always busy. It's a busy time. You got holidays, you got friends, you got parties, you got gifts, you got all kinds of things going on. You got snowstorms. and I don't always have the time to make sure I know where I'm going to give, you can start something called a donor advised fund. Now, or a DAF for short. A donor advised fund is really neat because what it does is you put money into it. Say, example, oh man, I want to put $1,000 away for charity. I'm not sure who I want to donate to, and I really don't have the time over the holidays, so I'm just going to dump it into the DAF. Guess what? You get a tax deduction for that. You get your $1,000 tax deduction for the donation, but guess what? You don't have to do. You don't have to decide who or what qualified charitable organization it goes to, which is nice. You can let it sit in there and accumulate interest. And then eventually, when you decide, oh, you know what? I met this wonderful ministry and they just really impressed on me that they're doing a good work in the world. And I want to take that $1,000 out of my DAF and I want to put it into this ministry. Now, you don't get to double dip because you already deducted it, but what a powerful tool to begin to put money away for charity and not have to be burdened or feel rushed to give to any one particular charity. So look into the DAF. You can chat with a financial advisor for that. Also, appreciated assets fit into that. In other words, anything that's increase in value, so you don't have to pay capital gains on it. If you were just to sell that appreciated asset, whether it's a stock, whether it's a piece of property, a car, whether it's a collectible artwork, and you put it into the DAF, you get the appreciated value as a deduction, and you don't have to pay any tax on it. So don't sell that item, then give the cash away because now you're going to pay capital gains on that appreciated asset sale. So there's no reason to do that. Just donate it and put it into your DAF. Fantastic tax hack. So then you're going to transform your tax into purpose and you're going to show some generosity. That's tax efficient and tax savvy. All right, number 9. This is really important. Use separate bank accounts for business and personal. All right, friends. We know a lot of people are guilty of this. They use their business card for personal and they use their personal card for business, and sometimes it doesn't always get transferred over. So you might be missing out on deductions, and you might be also what we call piercing the corporate veil and commingling funds. Both of those terms sound ominous because they are. They are big no-nos. If you pierce the corporate veil, you commingle funds, especially if you have an LLC or an S corp or any type of entity that has a protection status. In other words, all the assets of your personal assets are protected because you've separated your business by forming an LLC. Well, when you pierce the corporate veil, it is just what it says it is. You're piercing it. In other words, you're making that there may not be a distinction. I can't practice law without a law degree, so I can't go into too much of the legal piece of it. But I can tell you this, that that's a bad thing to do. All right, so keep those expenses separate. Now, could you use your personal card for business expenses and get a reimbursement for that? Of course, that happens all the time. And that goes back to the reimbursement form, accountable plan, et cetera. But don't commingle funds. Use your business credit cards or business account to pay personal bills, which includes your tax bill. So if you have a personal tax bill, pay that out of your personal account. Get a distribution, take a dividend, whatever it might be, and pay that bill. It's always good to categorize in bookkeeping software if you can, and make sure you track it all, and then review your books on a monthly basis. Lastly, number 10, these are complicated, whether it's with us or with somebody else. Work with somebody who's going to help you with tax planning, whether, it may be an individual, maybe a firm like ours, whether it's a group and you're in a community. Somebody who's proactive and planning will help you write your tax story before it's filed. You want to have a tax story that is amazing. You want to, like our clients, we've had so many of our clients just implement a few of these strategies and they save quite a bit of money. I mean, from a few $1,000s to 10, 20, 30, 40, $50,000. So you don't build wealth by necessarily earning more. You build it by keeping more of what you earned. And there you have it. And so we did it. We did it again, Yolanda. Merry Christmas, everybody.
This was excellent. Does anyone have any questions?
Probably more of like head swirling, right?
Yeah, it was a lot. It was a lot, but good stuff.
Yeah,
And I think the overall theme is uh, get someone that knows this stuff to work with you and your business, so you can, as you say, receive more money back in ways that we had no idea that were available to us.
100%. Yeah, this helps to open the doorway, right? Open the doorway. Now you can see some of it is like, oh, I can do a little of this on my own, and some of it's like, wow, if I just get a little bit of help, I can really, really do a good work with what I've been entrusted with.
Yeah, and I mean, half of the businesses that I speak with, I'm sure they're not even keenly aware of some of these things that they should be doing that are within their right to do so and would bring a lot of money that they can use for other things back into their budget. So, Nate, I appreciate this.
Appreciate you, appreciate JP, appreciate Ignite, everything we're doing.
Hey, Nate.
Cool.
I do have a quick question though. Can you explain the vehicle thing a little bit more? So like, scenario wise, like, because like if we buy a vehicle and we pay, like we pay for the full entire amount of the vehicle, like all at one time, is that how we can do the deduction, or how does it work? Like, if we buy the vehicle, put a down
Yep.
payment like regular,
Yep.
and then we have payments on it.
Yep.
How do you
Great
do
question. Yep. So good news. Whether you pay for it in full cash or you take a loan, the deduction is the same. Makes no difference. You get the same deduction because the IRS doesn't care where you got the money from. They just want to make sure. They just want to know that you actually made the purchase. So you could buy it on a credit card. You can buy cars on credit cards now. Yeah, you can put it on a credit card.
Hmm.
Yeah. Oh, yeah.
Interesting. Okay.
Yeah.
And then does it have to be like same calendar year that you buy the vehicle that you take that deduction, or how does that work also then? Or like
So
because example, like for, some of us like, okay, I'm making this up hard, but like we bought a vehicle, 2 years ago, but we're starting the business now. And now we're starting to use the vehicle for business purposes. Can you explain like how that scenario works?
that's a great question. So it goes by the in-use date. So that's a big bonus for you because if you don't start using it until the year of 2025, well, that's when the clock starts ticking. That's when the deduction starts. So that's fantastic as well for you. So, that's the other part of what I was saying earlier, not to just buy something 1231 and get it on 1/2 or 1/3, right? So you bought something on Amazon and then you're not going to get the deduction for it because the in-use date could not have possibly been in 2025 because you didn't even receive it until 2026. So that's when we use the in-use date. Now, still a deduction in 2026. And by the way, something else that's important, we don't always want to write everything off that year. You know what? You might be like, "Hey, I'm running hot this year. I'm not even making money. Let's throttle that for the next year." Fantastic. That's why it's so good to do planning, right? That's why it's so good to sit with somebody so you can analyze those numbers and see what we want to deduct this year, what we want to deduct next year, because that in use date might be really important for them too, because your accountant might say, oof, we're going to just wait until next year to actually put this in use because you don't need it this year. Great
Cool.
question.
That was good. Any other questions? Okay. Well, Nate, everyone on the call, have a wonderful remainder to your week, and I'll see you guys next week.
See you
Bye bye.
guys.
Bye bye.
And we'll see you tomorrow, Nate.
That's right. I'll be
Yeah.
wearing one of my hats.
Oh, did you see
Excellent.
the thing Andrew did for you?
No, I'd love to see that.
It was in our newsletter.
Oh, I can't wait to open it. I haven't even looked yet.
Oh,
Okay. What'd
that's
you say,
fair.
Andrew?
That's fair.
Okay, cool.
I
Cool.
can't
Look
wait.
at
I'm
it.
going to open it now. Yes,
All
excited.
right.
Shout out. Thank you, brother.
Bye, y'all.
Absolutely.
All right,
Take care,
bye,
guys.
guys.
Thanks, guys.
Bye,
You're
Jennifer.
welcome, Jennifer.